Welcome to our returning subscribers and guests. MarketMark is a financial markets channel seeking the pursuit of educating everyone about the financial markets and my own personal trading strategies. If you enjoy my content, please consider subscribing and liking this video as well as other videos. Commenting, sharing, and providing feedback is greatly appreciated and assists the YouTube algorithm. The required disclaimer is as follows. MarketMark is a YouTube channel which provides trading ideologies and investment strategies. However, MarketMark is not a tailored investment advisor nor providing any solicited financial advice for any of the contents which he distributes via his content. MarketMark will not be held liable for any trading losses or financial stress which you may encounter. Please do your own research for anything to do with financial matters in your life. This channel only provides educational insights into the worldwide financial markets. Again, I'm not a financial advisor, nor do I obtain any legal credentials as of yet to provide financial advice to any of my subscribers. In this video, I will be discussing and elaborating the importance and utility of financial ratios in the markets in order to achieve the best returns on investment with the ultimate goal of retiring or becoming financially free prior to the majority of the people in this world, according to myself and my own research from past historical trends, books, and other forms of educational content. In this video, I'll be discussing and demonstrating how a regular trader or investor can successfully utilize financial ratios within markets in order to achieve the best returns, as I previously said. Now, we can be using these ratios in a variety of markets, such as commodities, government bonds, exchange-traded funds, products, and notes, stock indices, which obviously measure a basket of companies within an index, currencies on the Forex, as well as using your own custom ratios to compare your investments with current economic situations in the world and fluctuations in the business cycle and future economic outcomes. In the first segment of this video, I'll be discussing the importance, utility, and reliability of investing in the commodity markets, specifically precious metals based markets upon ratios. Now, why would we want to be using ratios when investing in the precious metals sector? Firstly, if we look at the chart from silverbullion.com, based in Singapore, clearly as you can see, the goal of a ratio, which is how many silver ounces to get to 1 ounce of gold. And for any gold or precious metal investor or even trader, we all know that gold is the king market. Gold is the economic signal as to whether the other precious metals will also do well in a bull or do poorly in a bear market. Now, as we can see, in a bull market, the ratio declines. And towards the latter part, or the conclusion of the bull market, we usually see euphoria and absolute happiness, joy, and overexuberance, which is a classic sign in any market of a major long-term high, or at least a high compared to other historical prices. However, in a bear market, specifically in the commodity sector, the gold silver ratio, or gold platinum ratio, or gold platinum palladium, whichever ratio, we're going to be using the gold silver ratio for this example. We should see the ratio go down in a bull market. However, as you can see, when we move up, that is signaling that both gold and silver is in a bear market. Now, if we simply use the ratio to judge whether to be buying gold or silver, or if it's even gold to platinum, as we can see in this chart here, gold to platinum, we can see from this chart clearly that we are, from 1997 at least, dramatically on the undervalued side of the platinum market compared to gold. What does this mean? This means that currently we need 1.79 ounces of platinum to get 1 ounce of gold. So this is telling you that platinum should at least return to the mean, according to this chart, should be around, if we just use a Fibonacci retracement from the high to the extreme low, we are relatively still undervalued on the platinum side. 1.5 is the average with the extremes. However, from historical trends, really without the extremities, we should be really somewhere around here, 1.15 or slightly lower. This is telling you that for now, platinum appears to be a better buy for the long term than gold. Now, if we can see this ratio go up still, that's fine. But the harder we go up is telling you the more we're going down in the platinum value. So platinum is getting undervalued at that point dramatically. So in a commodity bull market, which I strongly believe we are in, because government bond values are at all-time highs for the past 40 years, since the 80s, we've been having low interest rates consecutively for the past 40 years. But what happens when we enter a bear market in the bond market, which, if you look at the chart, as we can see from here, governments cannot print forever. And the further we go down on this chart, the more in debt governments are becoming. And as we know, when people lose faith in government, for whatever reason, if it's because they have promised certain things to its citizens and there's no trust anymore in government, well then the assets start moving out of the bond market, and we do then get inflation. So really, when the confidence cracks in government, we're going to see this yield spike quite dramatically. Will this be great for homeowners? Most likely not. Will it be great for precious metal investors, such as myself? Most likely yes, because in inflation, especially when the yields are rising, this is telling you that credit risks are getting amplified. So less and less people will be borrowing money the higher the interest rate goes, which means that speculative bubbles per se will be less prone to occur. Of course, we do have an exception with the gold price in 1980, or from the 70s into the 80s, because we went up dramatically, about 800% within a few years on the gold price. And silver went from, as we can see here, we went from about $6 to almost $49, $48 in just a matter of actually 1 year. We went that fast up. Of course, what happens after that, such a dramatic move to the upside, you get a prolonged bear market. And that's what we saw happen. But the point is that we saw yields going up dramatically, tremendously during this period, as Jimmy Carter was a president, and unfortunately, the public did not have any confidence or had little confidence in his administration, and therefore we saw the yields go up, government bonds value going down, investors not investing in government and instead investing in inflationary protective assets such as gold, silver, platinum, palladium. Now, going back to platinum. If we go gold to platinum. So initially, we should expect possibly for this ratio to increase. But longer term, I strongly believe with the forces of both inflation, money printing, and the confidence in government, and the decline in the purchasing power of your savings, any fiat currency for that matter, we're going to see platinum most likely outperform gold on a percentage basis. So we could move up here, create one final second lower high, which would be extremely bullish for platinum in comparison to gold, and then we make our way down, and eventually we should be getting a capitulation in this ratio, which is meaning that gold is drastically overperforming gold, and therefore we should expect to take profits and shift into whichever asset class or markets is undervalued at that time. So we can use this for platinum and palladium. We can see that with platinum compared to palladium, we saw platinum's value in comparison to palladium have a major high in 2009 before the GFC happened. And we've come down dramatically, and we had all-time lows. So we should expect for not palladium to do poorly, but for platinum to regain its strength and to actually perform relatively well in comparison to this chart. We should expect to hit 1.5 and upwards, and how high we go depends on how high gold and palladium go. But we should expect for this ratio to go up considerably, but not to say that we cannot go down a little bit more first, get everyone capitulating out of platinum, and then when we see the industrial demand pick up for catalytic converters and other industrial uses of platinum, bearing in mind that platinum is 30 times more rare than gold, and currently half the price as we saw previously on the ratio. So we should expect for this ratio longer term in the coming years to go up quite dramatically. And if we start going up ballistic and tremendously, then perhaps we should be getting off platinum, which is currently 1,000 US approximately an ounce, into the next undervalued asset. So this is platinum to palladium. We've covered gold to silver, gold to platinum, and gold to palladium. So gold to palladium, we can see the same thing, and that palladium should do the same thing as platinum. We should be seeing platinum, palladium, silver, rhodium possibly outperforming gold on a percentage basis. Not sure about rhodium, since rhodium is already tremendously high. It is expensive. Can it go further upwards? Yes. However, we both know that we want to be in undervalued assets. And in the commodity sector, for this upcoming bull market in gold, silver, and in general the precious metals sector, we want to be in the most undervalued assets possible, bearing in mind that both silver and platinum are still 50% from their all-time highs. You got stock indexes, you got ETFs, you got almost everything at all-time highs, but we do not see the metals at all-time highs, except for gold, which did recently tap the $2,000 mark in 2020. And I strongly believe as long as we have a protracted and prolonged correction in the gold price for the rest of this year, the further we go down in the price of gold is going to propel gold to go much higher, considerably higher. And if we're going to see a major commodity boom, we should expect to go maybe not as low as here, but something like this. So we should go down first to create an ideal, powerful bull market, get everyone trapped into a bearish side, and then you turn around and then everyone is forced to buy back their short positions, and eventually, when it creates new highs, the retail market comes back in and pumps it all the way up until we have euphoria. Next is going to be, as I mentioned before, will be ETFs. So we've covered commodities now, and bonds as well. So next will be second part. How do you use ratios with government bonds and corporate bond markets? Well, here we have the LQD, the iShares Grade Corporate Bond ETF, measuring that denomination of particular bond market indices used by professionals in finance. So we're using this to measure against other currencies. It's important to understand, do not say I'm making lots of money on the Venezuelan stock market or the Argentine stock market, when we can clearly see, for example, the IMV, which is the Merval in Argentina, compared to the euro, the EXY currency, which the euro currency index, as the dollar index, is measured against the US dollar, the Swiss franc, Canadian dollar, and Swiss franc. So we're measuring against different currencies and Japanese yen, and therefore it's important to understand that this recent market rally in the US share markets has been primarily due to a decline in the US dollar and strength in the euro. However, I believe that, and according to the European bond markets, we are at all-time highs, and therefore negative interest rates, or even zero or below, in many countries in Europe, including Germany, Italy, Spain, and a few other of the European EU nations. We're at negative interest rates, which means that we're at all-time highs for bond prices. But what happens when people lose confidence in government for this current cycle, which is going to push gold and precious metals to new highs? Well, we're going to be seeing the euro dramatically fall, sucking in capital into the United States. So it's important to understand that we are going upwards in certain markets, but am I making money on the markets because the currency is declining, or am I actually making money because am I making a fortune because the market's going up and the currency which is denominated in is also going up? So eventually I do expect for the Dow to go up quite dramatically and to be testing 40,000, but we should see a correction first, as I mentioned a few months ago, about 35,000 now. So we will go to 40,000 eventually. I strongly believe this. Why? Not because of the companies, but we are in a massive bond market bubble. The stock market compared to the bond market is not in a bubble. We are in a bubble in the government bond markets. And as money leaves the bond market in the 10-year yield or in the 30-year yield, which is the inverse of the bond price, we're going to see smart money shift into equities, commodities, and we may not see such a dramatic rally in the Nasdaq because inflation typically is not good for these high growth innovation companies. So at one point I do expect for the Dow and the S&P to go up quite dramatically, but a correction we should be seeing first before we go up. And just a reminder, when we go down really fast, well then we should expect to come up just as fast because the markets do overcorrect both to the downside and to the upside. So next will be, we've covered the commodity markets, bond markets. Now will be the stock market. So stock market and how you use these ratios. You just type in the ticker. So say SPX in comparison to the euro currency index. So we can see that we've been going up extremely, quite dramatically. We've been going up very dramatically in terms of the S&P compared to the euro. But if you go S&PX compared to the Dixie, which is the dollar currency index, we can see that we have been going even further. Why is this? Because the dollar in the past year has not done too well. In fact, because dollar and the euro are pretty much opposites, we have seen a dramatic rally in the US share markets in US dollar terms. However, in euro terms or in other currency terms, we haven't done actually as well on a percentage basis. How about if we go the Merval, which is the Argentine stock market, in comparison to the Dixie? So we've been going up quite dramatically, yes, in the Argentine stock market. But if we go IMV just by itself, in terms of IMV, which is the Argentine stock market general index, we have been going up more dramatically in Argentine peso terms. Why? The Argentine peso is hyperinflating. The public has lost confidence in government over there. So the only reason the dollar has remained strong, even despite the enormous money supply increases, is because it's a world reserve currency. And what we know from all financial panics in the past, at least in the past 50, 60 years, that when we see a panic in the stock markets or in gold and silver or bond markets or corporate or currencies, we always see a flight to safety in the Dixie. And quite frankly, and surprisingly, we have been forming a descending wedge, which is a bullish pattern. So if we are breaking out here with a Dixie, I know I'm going off on a tangent, but the more information you learn from this channel, the better for you, not financial advice. We're going to be going up to 100 potentially if this pattern does play out. And these types of patterns do have a high probability of playing out. Of course, there's no certainty, and we could just fall back here, retest these lows, and go further down. However, I think that the euro and the European countries are in far worse situation than the dollar and the North American nations. So I think we should actually expect for Europeans to be liquidating their currency going into dollars, at least on a short-term basis. And again, this is primarily due to a panic liquidity crisis in the markets as Europeans seek safety, shelter into the dollar, which is most often a risk-off sentiment. However, we could be going against that philosophy in the coming years. If we see the stock market, the US dollar, and precious metals go up, this is telling you, and we see obviously a decline in the US bond market prices and hence rising yields, then we're going to be getting a capital flight, money will be flowing into the United States, out of Europe, out of Japan, going into the US, primarily into commodities and equities. In the equity market, most likely will be energy and possibly materials, but commodities and energy companies more specifically. And if the dollar goes up with that and the euro declines, well then foreigners are going to make a lot of money because they're making money both on the stock market and because their investments are priced in US dollars in terms of the US share market, and therefore they're making substantially more than they regularly would in their own current share market. For example, the All Odds in comparison to the euro. We've barely made a new all-time high. However, so we're comparing the odds in comparison to the euro. So priced in euros. But if we look at the all odds in Australian dollars, we have actually surpassed this high of the pre-business cycle correction that we had, which has obviously, as we said before, helped propel the market to new all-time highs. However, the point is that when we're measuring the stock indices in their own currencies in comparison to other currencies which have been stronger in comparison to the local currency, this is important for foreigners to understand. Because if you're investing in the Bovespa, which is the Brazilian stock market, and we price that in euros, we've barely made new all-time high. How about if we just go Bovespa in Brazilian terms, in the Brazilian real? We made new all-time highs and actually went further. So it's important to understand this so we're not investing into the Mexican stock market and then we make a lot of money, but then the currency, the Mexican peso, falls by 50%, so you didn't make money at all. Ideally, we want to be investing in markets where the currency is priced in a strong currency, preferably even a foreign currency such as the US dollar. If you're living in wherever, or if you're living in the States, it doesn't. It just depends on the situation where you live. But we want to be ideally finding markets where we make the most money because we're investing both in a rising market, getting in at the end of a bear market or sharp correction, and then we go up, but the currency that it is priced in is also maintaining strength, not just investing into a hyperinflating stock market with a currency that's eroding because of uncontrolled money printing and loss of confidence. When people lose confidence in the government, then they just go out and buy whatever they dreamed of. But if you have people that trust government, well, they're not going to be venturing out into different investments because, oh, I'm okay, it's conservative, I'm happy, I don't need to invest in the gold or silver because government bonds are doing really well. But when everyone gets out of government bonds and there's a panic, well, then we have public and private assets. Private assets being commodities and equities. So eventually, we should expect for the US share markets to do extremely well. However, it would be best for us to go down first, which provides the short sellers and bears one last chance to get out before the market takes off. And if we get a large majority of people, 70-90% of people, calling for the end of the world when the markets have a sharp correction, then we will see we will probably see a repeat of the 87 or 2007 events, where we go down first sharply, and then thereafter we go up quite dramatically. So in 1987, we went down, came down about how much? Almost 40%, but within 1-2 years, we took out the previous year's highs. So this is how we want to be making money. We want to be buying in a panic. And how do we use this? The VIX. The VIX is telling us when we should be getting greedy and fearful in the markets. Obviously, a contrarian indicator. Next will be in the third part of this video. So I've already covered the previous parts. The third part is obviously Venezuelan stock market. We had the best performing return on investment of any stock index worldwide. However, the currency went to crap. Venezuelan stock market chart. As we can see here, we went parabolic. Is it because of actually good companies making money? No. Because the stock market is priced in a foreign currency and you're making, yes, money in the currency, but the currency is going in the opposite direction. So, if we use, you can also use the data from Fred, from the St. Louis Fed, as part of your ratios, M2 or the UKX. So we can see here, I know I'm jumping across a lot of topics, not sticking to one topic specifically, but it's important. I think it's important to give a combination because everything interlinks and everything is interconnected in the markets. Nothing is by itself. As we know, both the oil price and the Dow Jones Transportation Index is an extremely great indicator of the economic health in the states. As we know, transportation is the most important part of any economy. So the DTX, the oil price, crude, and the 10-year yield, which is the interest rate, have profound effects on the economy. Next will be comparing Bitcoin to like the dollar. So Bitcoin, if we compare it to the EXY, to the Euro currency index. So with a ratio, we can't really use it for this market because Bitcoin is the fastest growing asset of any asset in the world, and we've seen extreme gains for anyone who's been in this crypto market in the past decade. Not saying that the trend will continue, but I do think that trend will continue. Now, here is a ratio of the market cap Bitcoin dominance. What is this telling you? We have Bitcoin and then we have altcoins. Now, in the cryptocurrency markets, we need to use this ratio or index to determine whether to be investing in Bitcoin or in the altcoins. Why? Well, if you're a long-term hodler and just want to hold Bitcoin and don't want to make any substantial gains with any other coins, then you won't need this. However, if you want to be making more Bitcoin by utilizing the upturns and bull markets of Bitcoin, as we know, Bitcoin has a cycle roughly every 4 years with the halvening, which corresponds with the shortening of the supply in Bitcoins being mined. So when we went into 2017, we saw a dramatic decline in the dominance, which was telling you that not only new altcoins were entering the marketplace, but also a tremendous amount of capital was making its way into the altcoins rather than just Bitcoin. However, when we bottomed out in the dominance and had the Bitcoin and altcoin mega boom in 2018 in start of the year, which was seen here, that was the bull market parabola. That was the end. And therefore we went into a bear market and dominance rose. And 2019 and in 2000, so we didn't really start an altcoin season until the end of 2020 or commencement of 2021. That's when we saw the altcoins really go upwards. Now, I still believe that Bitcoin is going to $100,000, but on this current bull cycle, I'm not sure. Longer term, in the next 5-6 years, I think we won't go to $100,000. I think we'll go even higher than that. $300,000, $500,000, I think that's more than possible. However, it would take time. And a lot of capital is going to be needed to push this Bitcoin market to $100,000 and beyond. Yes, we could hit it this year, we could. However, I think that it's much safer to be trimming profits earlier, perhaps at $60,000, $70,000, $80,000, $90,000, because I believe that we will be entering the last phase of the Bitcoin bull market. Why do I say that? If you look historically, we see that Bitcoin typically makes a parabolic move to end a bull market, followed by a tremendous bear market, and then bull market, and then bear market. Just the way the cycles are. Now, going back to the ratios, we'll finish the dominance first. Dominance. When we see this dominance capitulate and it goes down extremely fast, that's going to be a sign to get out of altcoins, go potentially into Bitcoin, but preferably US dollars, and if you have the courage to do so, select a few inverse altcoins on a short-term basis if you're trading the cryptocurrency market to make those gains while the altcoins come down in value. Therefore, you're getting more value trading the actual cryptocurrency market. It's not for everyone. These markets, cryptocurrency markets, are extremely volatile. The most volatile of any market in the world, actually, currently. So if you're a trader, you could be doing that using, for example, XRP Bear. Now, these are not long-term holds. These are only for a short-term basis. And as you can see, if you get those spikes, you can make 100% in just a few days, protecting your gains from making the money on the actual coin itself. And you get the inverse leverage token, which I think is a much better way of shorting the market in cryptocurrency than leverage trading. Because leverage trading on cryptocurrencies is extremely risky, and it doesn't take much for you to get wiped out on a trade, whether you're long or short. Now finishing the video will be using the Bitcoin to the gold price. So we can see here that we have got Bitcoin has still way outperformed gold considerably, no surprise. But when we see this this go up, you want to be obviously selling Bitcoin for possibly gold or platinum or silver. And when this goes down, obviously we'll be buying Bitcoin. So many people actually don't even buy or trade Bitcoin for US dollars. They just do it via gold and silver or precious metals. And this way you're staying out of the fiat system and accumulating hard assets, but also using the boom, the bull market in Bitcoin to accumulate more precious metals. And when the Bitcoin price does go down considerably, then you can be selling gold and buying Bitcoin. So this doesn't work for everyone, but some people do like doing this to accumulate more assets and not simply fiat currency. So finishing up this video, if you want to do any ratio on any chart, you just type in what you want to buy. So if you want to buy silver, and you measure it against the Dow. So we're seeing here that I'm personally not going to be selling any silver until we get some kind of parabolic move in this chart. What is this saying? Silver, in comparison to the Dow Jones, hit an all-time record high in the record bull market in the 70s, late 70s into 1980. But we are at historic lows, all-time lows, even from even before the 70s. So this is telling you that silver is crazily undervalued. Yes, we can go down first, retesting support at $20, possibly below, and if it goes to $20 and below, I'll be buying quite aggressively. Below $18 and below, I'll be buying even more aggressively, injecting more capital into the market. So we can see that silver and platinum and palladium have much further to appreciate in value in compared to the stock market. So I hope this video explains the utility and reliability and the usefulness of financial ratios when determining when to invest and how much to invest in a particular market. I personally will be using the goals of a ratio to determine my exit into perhaps gold or another undervalued asset at the time. Now, I will also be using the gold Dow ratio, the silver Dow ratio, silver S&P 500 ratio. I'll be using numerous ratios to be exiting my positions in those markets. Now, why do I use the ratios apart from just getting whatever is most undervalued and the accumulation of assets, both digital and tangible? Why? Because if we're measuring a financial market against a fiat currency, we both know that since time immemorial, especially since 1971, when Nixon took the dollar off the gold standard, that the gold price went up extremely in comparison to the dollar. Now, was this really gold going up or the dollar going down? Well, I think it's the latter, and that it was actually gold going up considerably, but mainly the dollar eroding in purchasing power as they print and devalue the currency. So from 1930, when $20, and then 35, and then in 1971, we were at about 40 bucks, and then after that, we've just taken off. We've just taken off, and now we're at 1840. So we need to be aware of these ratios, because these ratios in any market, comparing to another market, whether it's a fiat currency or a stock index or the M2 money supply or the house price indexes of the US or other countries, where the most important part of these ratios is to determine where value is found, not get killed by a eroding currency, yet the market is ballooning in value. But remember, again, it's the currency that's going down. And we're using silver in comparison to other markets or any other commodity or stock, anything. It eliminates the delusion of the fiat currency diminishing value price over time. This is why many experts, I'm no expert, I'm just a regular guy trading the markets. But many experts do use the ratios to determine where value is found, and when not sometimes, but whenever you need to be cautious, lighten your positions and go into other undervalued markets. So I hope this explains market ratios and how to utilize them. And I did go on a tangent with talking about general forecasts for the markets, because it is important to understand how everything is interconnected. So in short, I do expect the Dow to go up even further. However, a correction of 20, 30, 40, or even 50% would guarantee, most likely in my opinion, not financial advice, for us to go up even further and take out new all-time highs. How? As the market goes up, majority try to short the market, and then what do we see? They are forced to buy back, causing even more fuel to the upside. So I am still buying the BBUS as insurance, and will be looking for an absolute panic in the markets if it were to occur, which I strongly do believe still at the US share markets, specifically the Dow, will have a correction in the not too distant future, most likely this year, and at least 20% correction, minimum, if not further. But I am a long-term bull on this stock market, as we have not yet seen the parabolic move in the stock market where you see the average Joe trying to get into the market. The majority of people, I'm not talking about the stock markets, talking about other current affairs. But when we see the majority pile in to the stock markets, and we get crazy melt ups, that could be the sign of the peak. So I'll be using the BBUS to sell when this goes up. Again, market correction would result in the BBUS going to the moon temporarily. Then I would sell the BBUS, and the further this goes up, as with the VIX, more aggressive, I'll be purchasing assets in a liquidity crunch, which this is the opposite of a liquidity crunch. This chart, when we see this go up, liquidity crunch, liquidity crisis. When we go down, well then everything's happy, complacency. But when this goes up, and I think it will, sincerely, this year, quite dramatically, will be going up. I don't know how far we're going to go up, but we'll be going to at least retest these lows or previous highs. The further we go up, the more aggressive I'll be selling this, and at one point, which I'll make a video in the future, if the US share markets do have a correction of substantial percentages, 20%, 30%, 40%, or even 50%, and I am still buying the UVIXI, and I am also having a small position in a more leveraged version of the VIX, of the UVIXI, which is the Wisdom Tree Multi-Asset Issuer Public Limited Wisdom Tree Short-Term Futures VIX Contracts ETF, 2.25 times leveraged. This is designed to go to zero long term. However, if you are able to pick a temporary high in the US share markets, specifically the S&P, this is going to skyrocket temporarily, which again provides a value investor the opportunity to sell something in a liquidity crunch, provides them cash to invest even further into the US share markets, or any market for that matter. And I will also be buying the leveraged version of the S&P, the Russell 2000, the mid-cap 400, the Dow 30, and the UXI. Now, as these are leveraged in a liquidity crisis and market correction, we should expect these to come down dramatically, if not in a waterfall style event like we saw in 2020. If we see this happen, the further this goes down, the more aggressive I am buying it, because long term I do believe we're going up still, because the bond markets are going to implode at some point, unfortunately, and we're going to see bond values plummet, yields rise, and at some point that capital is going to rush into US share markets, specifically the Dow, and commodities, energy, and those kinds of private assets. Tangibles, collectibles, we should also see appreciate in value in an inflationary environment where yields go up. Even in this situation, if the dollar goes up in the Dixie, I still expect the dollar to lose purchasing power, but in the Forex markets, we could still see the dollar index skyrocket higher, even with a rising share market, which will confuse many people, most likely trying to short the market. But I think that this would provide even greater fuel to the upside. So I hope that this video explains the importance of ratios when determining what to buy, when to buy it, and how much to go in, and how aggressive or how perhaps dovish you are to invest in a particular market, buy, sell for long term, and for long term getting out as well. And also, hopefully this explains my short term forecasts. Lastly, silver I do believe will go up. We're testing $50 in the coming years. However, it would be better if we go down first, wipe everyone out, and then go up and test new highs, and then eventually break $50 and go even higher. And that goal to ratio will plummet. Now, I think that this ratio will quite easily take out 50, 40, and if you're in a commodity super cycle, then we should take out 30. But this will take time. It's not a trade. This is a long-term investment / trade, not a swing trade. This is a multi-year investment, and I do believe this ratio can go up first, and then the faster we go up, the more dramatic we go down afterwards. So I hope this explains a lot of information, and if you do not understand parts of the video, please do timestamp them and comment in the comment section. Please do like this video and subscribe to my channel. Any suggestions of videos or topics are more than welcome. Thank you for watching. This has been Market Mark with your financial markets research and commentary. Have a great day wherever you are in the world, and just be careful with the US share markets at this time. Cash is still king, and not financial advice, but be ready to be buying in a panic. Yes, I will make a video if we do see a substantial sharp correction in the US share markets, commodities, and in any other market. So thank you for watching. Please do subscribe to my channel and have a great day. Peace and love to all of you.